Oh, hey everybody. Welcome to the morning market briefing. It's inflation day. A lot of people are saying every day is inflation day. As of late, we are looking for the CPI print, Wednesday, August 10th, 2022, by the way. The expectation year over year, our last reading came in at 9.1. People looking for headline somewhere in the 8.7, 8.8 range. Core inflation last reading was 5.9. People looking for right around 6.1. Tom, numbers.
So year over year, CPI as of this morning is 8.5%. So we came in under. It was right there. I think it was 8.78 was the expectation. So depending on where you look, it was 8.8 or 8.7, depending on how they rounded it. But 8.5 is the number. Core CPI 5.9. So no change month over month, which is an exceptionally good number. If you look at the bond market right now, so this morning we're seeing nothing but red. The 10-year treasury was all the way up. I mean, it was up 11 basis points, moving pretty high. And that has changed significantly. We now see the 10-year at a 268, which is a 12 basis point swing to the downside now. 30-year now under 3%. I mean, this is a number that was not being anticipated this morning. I think most everyone thought we were going to come in hot. I thought we were going to come in a little bit hot. And the bond market was definitely indicating that, and it has fully reversed and is now going full speed in reverse. So it's like not only were we going quickly one way, but now we're going quickly the opposite way. I mean, it's green across the board. Inflation for the first time, what feels like forever, is coming down, even if it's only 0.2 of a basis point under expectation, or 20 basis points, 0.2%. So Ben, I know has the full numbers pulled up on the Department of Labor statistics. So why don't you jump in on those, Ben?
Yeah, I think it's pretty interesting. So we saw the decline in energy, and energy prices really definitely had a big role in this. They were down 4.6% on the month, still up 33% on a year-over-year basis, but definitely coming down. If we go to the core, we did see a deceleration on the core side as well. That was driven by used cars and trucks, which were down 0.4 on a month-over-month basis, and also a little bit on apparel. We saw a little bit of a decline on transportation services. So think things like air travel and that sort of thing. And so that definitely helped as well. We are continuing to see higher rates in shelter. That was up 5.5% on a year-over-year basis. And we're continuing to see higher rates on medical care services, but those were moving a little bit slower in general. If we look at other commodities other than food and energy, you're still up 7% on a year-over-year basis. New vehicles are still up 10%, but we're definitely starting to lap some of those higher prices that we saw from last year. So that I think it's a pretty good number. Still got to look through a little bit more in terms of the individual details here. I'm surprised that shelter wasn't up faster than it was. You are seeing an increase in shelter prices, but not nearly what we see in the market, whether we look at rent prices, et cetera. You're beginning to see a bit of an increase in acceleration in medical care services. So that is something to watch. But airline fares down 10% on a month-over-month basis definitely helped the numbers. And again, a lot of this is due to lower energy prices.
Yeah, it's interesting. I mean, it's a positive print. I mean, it's the first, I feel like, positive inflation data point we've seen in a while. I mean, going back into May, it was just like, man, this thing, we continue to have the bar too low in terms of where we expect to be. It's continually running hot. To actually come in lower, Tom, do you think this gives credence to the triple rate hikes we've been having? Does it give credence to Fed action, late though it was, actually working in a small degree? I mean, it's important to remember, although this is a positive, part of why I view it so positively, at least, is that it's a meaningful improvement from last month. The fact that you came in 0.2 under expectation, and expectation was 8.7 or 8.8, that's still kind of alarming, but to be well under that 9.1 number, I think, is a good move.
Yeah, it's a significant drop. You know, to Ben's point that we're seeing some acceleration on home price and the shelter portion of it, I think that number is still vastly underrepresented. But I was really surprised just looking across the numbers here. I mean, that there weren't further increases in stuff that, was away from energy and used cars. I mean, the biggest movers were the biggest movers again, but this time to the downside. And I think it was a lot more than people anticipated. And then the other stuff just wasn't up as much as I would have actually expected either.
Smartphones down 20% year over year.
Well,
Down.
Well, that was the Apple announced that they were cutting prices because they had too much inventory. I think that's definitely feeding through here. In terms of rate hikes, we're still pretty elevated. We've dropped from 2.8 rate hikes anticipated 2.73. So not a big change there. I think that number is pretty locked in, at least for the time being, until we get further guidance from the Fed. And I think that, ultimately, this is still really elevated. We're not at 2%. The expectation is they're going to continue to hike rates until they get to their target of 2%. So the question is, how quickly do we see that? If we saw, 0.7% drop this month, how much further is it going to go the following months? We're going to see energy prices continue to plummet. Is that really going to be a driver, or is that going to maybe hold off and we're going to kind of idle here at this level? I think that's going to dictate where we go on rate hikes. But the next number is going to be important.
Yeah, I think it's interesting looking at even, kind of Goldman's expectations on some of this stuff. They expect core inflation really to be in that 0.4 to 0.5% monthly, really for the next several months, then getting lower in December. But they kind of project us out to be at 6.1% in December, which is worth noting that's higher than we were in June. So that's still a very elevated number. Ben, where do you think we go from here?
Yeah, I mean, I think that this is going to be good the way they're seeing the world. I do think that some of the noisier pieces of the report, if you look at airfares and if you look at energy, and if you look at used cars, I think those came in a little bit lower than expectations, which Goldman's and other analysts are going to generally look through and say, we knew those were going to go down. Those are going down a little bit faster than we thought, but we're just kind of going to look through that. You still have, if you look at kind of the center of gravity where we are, we still have very elevated inflation, but you're starting to see some cracks. Big three headlines that I would say from this is apparel, appliances, and electronics. Definitely starting to see some deflation there. Prices are actually going down. And this makes sense. You're seeing a lot of these companies have too much inventory and have to liquidate. On the shelter side, I think that there's still upward mobility there. We'll have to see where that goes, but there was a little bit of a cooling off in July, and it seems like with mortgage rates going down, rent prices continue to go up. I wouldn't be surprised to see that actually reaccelerate. So I'm not really reading too much into the shelter deceleration. And then airfares, I think, is another big headline. This was really buoying the inflation print for the last few months, and that's beginning to fade away now as well. So apparel, shelter, and airfares, I think, are the big three to watch going forward. We're definitely seeing a little bit lower core inflation for now, but if you look at some of the price increases that are still going through, you're going to continue to have the consumer earn less in real dollars than they're spending. And I think that trend is continuing, although we may be seeing a little bit of deceleration in that. So that's something to watch as well.
We're definitely seeing a reaction on the equity markets as well, especially, as you look at some of these more even blue chip growth type stocks. Tesla up 4.5%, really popped right after this report. Netflix up 2.5%. Apple popped up close to 2%. It's come down a little bit. Google up 2%. Meta up 3.7%. So definitely seeing some reaction for those companies that are a little bit more oriented towards the growth, potentially thinking that, hey, rates are coming up. That's going to start curbing inflation. We're finally seeing proof of that, and maybe rates don't get too out of control. So interesting kind of equity market reaction. Any other CPI stuff for you guys?
I would just say higher probability of a soft landing. But when I say higher probability, I'm saying maybe we went from 5% to 15%.
Yeah. Switching gears dramatically, the UK is prepping for 4 days of electricity outages in January. Then what's going on here?
Yeah, I think they're just trying to get out in front of the story with, potentially some very, very bad news that could happen for the UK in the month of January. Basically saying if Norway shuts off its gas to and energy exports to the UK and coal exports, then they could have 4 days of no electricity in the very cold month of January. So they say it's unlikely to materialize, and this would be a kind of a reasonable worst case scenario. They're creating a plan for this. So they said under the plan, the network operator would initially override commercial agreements to direct flows of gas in the system. After that, supplies to gas-fired power stations would be halted, leading to power cuts for businesses and homes. They do make a note that we are not dependent on Russian energy imports, unlike Europe, and household businesses and industry can be confident they will get the electricity and gas they need, which seems a little bit at odds with the fact that they would turn it off for 4 days in January. But they're just trying to get, the British understanding of the gravity of the situation. Elsewhere, I mean, Germany's saying that the economy is looking very bad. And so this is not just unique to the UK. I think the UK is doing a good job about getting out in front of the story, whether you're looking at the Bank of England or whether you're looking at the estimates of what they plan to do if they have an energy shortage. I think that they're prepared, and they're prepared for a worst case scenario, which they like to be generally.
Hey, what a spin zone, though, that we're not relying on Russian energy like Europe is. We're just relying on European energy, which is relying on Europe. It's like, oh, I didn't order McDonald's, I ordered DoorDash, but they brought McDonald's. It's like an all-time spin zone there, I think.
Yeah, I mean,
it's like, what I mean? It's like, I didn't order this; they brought it to me.
We have plenty of coal that we can buy.
Yeah.
It's kind of weird. I don't know. It's a weird world, man.
Yeah.
Microsoft cutting costs. This comes on the heels of some anecdotal reports of layoffs and things like that from the company. Again, this is kind of thematic and something we've been seeing kind of across the board in different ways, shapes, and forms. How do you kind of digest the news from Microsoft? How are they doing this?
Yeah, it's really interesting. CFO Amy Hood last month told employees to, quote, think twice before submitting expenses.
Love that. Same here.
And it's very interesting, actually, because typically, I mean, at a small business, you'll pay for stuff and occasionally you won't expense it. But at Microsoft, the common thinking is, and any of those really big companies, just expense everything. It just put it on the company card. Well, at a recent picnic for one Microsoft team, managers actually paid for the employees' food and drinks instead of putting it on the company card. So I thought that was pretty interesting. And I think that's fairly unique to Microsoft, especially in that tech world. I just don't think that managers at Facebook would be paying with their company card with out of their own pocket for employees' food and drinks at a company picnic.
Yeah, it might poke them, but that's about it. Facebook joke there. Ford announcing increases on the F-150 Lightning price. This is the electric F-150. Cheapest version is now going to start at basically $47,000. It used to be under $40K. That pretty much immediately evaporates your $7,500 tax credit. I'm not surprised by this at all. I mean, I think you'd be hard pressed to find any type of Ford F-150 for under $47,000 that's new right now to begin with. So some of this is just kind of funny money and sticker price games, and dealers are having a lot of success pushing pricing through. They are crediting this to higher costs of materials as well as other factors. I think the other factors is there's just not enough supply, so we can charge what we want. I don't know if you guys have any disagreement on that, but it's not a shock to me.
No, I very much agree. GM raised its price on the Hummer by $6,500 last month. So the $7,500 to $20,000 increase from Ford is not a surprise. But clearly, again, it feeds the narrative that I don't think inflation has, it may have peaked, but it's not going to come down fast anytime soon.
I mean, I think the interesting stuff to read through, we got some notes here on the subsidy rules, which is that you can't get the subsidy if you buy an electric vehicle that's greater than 55,000 or an SUV that's greater than 80,000. But additionally, if you make more than $150,000, you can't get the subsidy either. So basically, if you buy one, you've got to spend 30% of your annual income on it post-tax, and then you can get $7,500 back. It's like, it seems like talking about
a bad incentive.
Yeah, laws of unintended consequences. You're going to have a bunch of people who are slaves to their car payments in search of $7,500 on their taxes, which is, you might as well just buy a cheaper car. I mean, it's a bad. Everything about this is not thoroughly thought through, I think.
Yeah, I tend to agree. I mean, it seems it seems to really lack awareness of the EV market as well. I mean, it's, the people that are, I feel like a large portion of people that actually are seriously in the market for electric vehicles are above that income level.
Yeah. You're either buying a Tesla or you're buying a Prius. You know what I mean? Like the Prius would be that under 55. It's not a super expensive car. We owned one for a while. It was basically a plastic death trap. But I feel like anybody who's really buying an EV it's more of a flex than anything. And you'd probably sell more if you let richer people buy them.
Probably so. Ben, you and I had a good laugh about this yesterday afternoon. Is AppLovin is buying Unity software for $15 billion. Basically a merger of equals. These are two companies that have a combined $4.5 billion in revenue.
But a combined market cap of about 35.
It's just unbelievable. I guess the goal here is they're going to be kind of a one-stop shop consolidated platform for people that develop mobile games and kind of corner the market. I mean, I almost wonder if the DOJ has anything to say with this, with the consolidation, or are they just kind of the way I am, which is what's AppLovin?
Yeah, I mean that's exactly how I was when I read this story. I mean, I was very surprised about the market caps of both these companies, frankly. Yeah, it'll be interesting to see what happens with this. It seems like Unity doesn't really want to do this deal either. They're trying to buy this Iron Source company, which, if you look at the stock chart of Iron Source, it's been straight down.
It was a de-SPAC.
I mean,
it was a SPAC company. So
I feel like it's just a merger of trash companies. I don't have a good appreciation for what they do. I think that providing the picks and shovels to people who develop mobile games, I think there is a market for that. But whether Unity or AppLovin or Iron Source is the one, it's so difficult to know.
Yeah, I'm just so far removed from that world. We're gonna wrap it up there. Should be an interesting day, I think, both on the equity as well as the fixed income side. We'll see what opportunities